Greetings traders and welcome to our 100th video. Yes, that is correct. You all made this possible, so thank you very much. By engaging in our videos, by encouraging and giving us feedback that you enjoy the content that we're coming out with, it helps us continue to come out with the content for you guys. And a long time has passed since the very beginning, and since then we have come out with 100 different videos, all with topics that are meant to provide you an edge. They're meant to provide you the information that you need to succeed better in the markets or to pass your gauntlet mini. So once again, guys, this is our 100th video, and I couldn't have done it without all of you out there, so thank you very much. Now, today's subject that we'll be covering is going to be price channels. It'll be a relatively interactive topic because we're going to be looking at a lot of visuals. We're going to be looking at what price channels look like. We're going to talk about what quantifies a price channel, as well as go into how price channels can be traded. This is basic price action at its core. I love this kind of stuff, and this is the type of stuff that I personally have found the most success in. Now, without further ado, let's get going and learn a thing or two about price channels and kick off this 100th video in a very good way. Cheers, folks. Many traders will tell you that identifying trends in the market is the key to making profits. The price channel trading strategy itself is a very clever way of spotting these trends, and honestly, a relatively simple one if that. In theory, recognizing the trends should allow us to make profitable trades if we're doing it correctly. So let's cover first what a price channel is. In simplest terms, a price channel is a range within price that it is fluctuating back and forth in a directional heading. So what does that mean? It means it is an average range of ups and downs that are occurring as the market overall travels up or overall travels down or even overall travels to the side. This is an example of what a price channel path might look like. We want to use this blue line to pretend that this is price's location. So price has risen here, bounced off resistance, fallen here, risen here, bounced off resistance, and fallen and found support again before finding resistance again and continuing the pattern over and over again. Now the idea here is the distance between the swing high and the swing low is consistent throughout this movement upwards. So even though that the highs are getting higher as well as the lows are getting higher, the distance between them is what is being identified here as a channel. The concept is we're paying attention to how price is currently behaving, and we're on the lookout for when something might be amiss. When this is no longer the case, when the market isn't moving in this type of a stride, that can be an indication that another movement might be getting ready to happen. So by being able to identify a price channel itself, we then can in turn give ourselves an expectation of what's to come based on how price leaves the channel. As traders, we can use price channels with a keen understanding of technical analysis to come up with very powerful reads. The information price channels provide us allows us to gauge the momentum and the direction of a trend. When we identify them correctly, that market information is just invaluable. If the price channel is trending upward over a given period, we can safely assume it's a bull market. If it is trending downward for a prolonged period, then we can safely assume that we're looking at a bearish market. Price channels also help us identify support and resistance levels, which is fundamental to any trading strategy. They allow us to spot ideal entry and exit locations on the chart. The support level is usually a crucial area in the market where we expect price to bounce up from either again during the channel action or later on if price returns to this area of support once breaking out of the channel. The resistance is quite similar the same way, where we're going to expect price to reject from this area either when it retraces to this within the channel or once we set that new high and we break outside of the price channel. It is very possible that these levels, these areas of support and resistance that are being found as the price channel bounces up and down along its path, these are areas where we very well might see action again in the future or another level formation. Not only do price channels provide us with those areas of resistance and support as it's moving along where we can potentially find entries from, but it also provides us an action that we can take once price finally leaves the price channel. So it provides us opportunities inside it as well as when it leaves it. It makes it a very versatile tool. When it leaves it, we call this a breakout. A breakout occurs when price that has been trading inside the channel finally closes, trades above, and stays above the top or the bottom of the channel. If it closes below the bottom of the channel, that would be the directional heading, we would anticipate some bearish activity as the market has broken the bottom. It has broken the floor, it has broken the area of support. If we break out the top side of the channel, this is breaking resistance, we generally view this as a bullish activity, and we're then looking for an opportunity to take advantage of that newly bullish momentum that we expect to take place in the market. There's three main types of channels that all channels really fall into as far as categories go. We have the bullish channel, the horizontal channel, and the bearish channel. Let's start off by taking a look at the bullish channel. The bullish channel forms when prices get constrained between upward sloping trend lines, hence the name ascending or bullish channel. The price is moving higher and establishes higher highs as well as higher lows along the way. The idea here is to remember that once again it still is a channel, so we want to see a very contained attitude about this, with the distance between the swing highs and the swing lows, if you were to follow it directly across, should be roughly the same at any point along the channel. If there's a distance between a swing low that occurs over here and a swing high that doesn't happen again until farther off down here, that's okay. What we want to see is we want to see the distance between the closest path between the upper and lower trend lines maintaining the same. And that's going to be the same for any type of channel for that matter. Then we have the bearish channel. The bearish channel is over here on the right, and the bearish channel is just going to be a downward sloping series of trend lines that are maintaining a distance apart as they work their way downward. So once again, we want to see those swing lows now progressively getting lower, and we want to see the swing highs also progressively getting lower. And the most important thing is to make sure that we are seeing a very similar distance between these locations all the way down. And then finally, we have ourselves a horizontal channel. The horizontal channel does exactly what the name suggests. It is a channel that isn't really predominantly controlled by a bullish or bearish market. It's going to happen when the markets don't really have a degree of agreement on where price should go. It's going to be represented by price moving upwards and downwards, but not really going to any new highs and not really going to any new lows. And as it does this, as it continuously progresses sideways more than any other direction, we want to make sure that once again that these channels, the areas between the support line and the resistance line, is roughly the same the whole way through. A horizontal channel is more of a neutral read and can be something that provides us both a bearish and bullish opportunity depending on which direction it breaks. Generally, with the bullish and bearish variation, we'd like to see bullish outcomes out of these channels. Now, it doesn't have to be that way. Ideally, the location of which the channel breaks is going to be the location of which we expect the first type of momentum to carry us. But generally, with a bullish channel, our ideal scenario is a break of the top side and look for a long opportunity. A bearish channel, we're going to look for a break of the bottom side and look for a short opportunity. The horizontal channel, we're going to look for a break of either side and look to go in the direction of the break. If we take a moment to talk about how we can actually draw and identify a price channel, in the real world this might seem a little bit scarier than just using a perfectly drawn line scenario that fits a textbook definition. Instead, we might see something like this. Here we're looking at a chart of Chevron, and what we have is a price channel, but it's not as clean as we might want. But the concept here is to always pay attention to the generalization and not overthink it. We want to pay attention to the highs and the lows along the way. If 80 or 90% of the highs and lows are fitting the channel perfectly, then we can go ahead and consider ourselves in some type of a price channel. But if we have a massive break like occurred down here, this would in fact be considered a break of the channel, and we no longer would be looking at this channel as a channel that that is currently holding. So in order to draw a price channel, the first thing that we need to do is draw off our main trend line. Now the main trend line is either going to be resistance if the market is working its way downward, or it's going to be support if the market is working its way upwards. Here we have some bearish activity, so it's going to be resistance. So let's start by drawing off the areas of resistance and just putting a line down. Now remember, with a channel line or a trend line, it has to be a straight line. Even though I can't perfectly draw a straight line with this drawing tool, the concept is we will be using a straight line, so you might end up with something like this where you have a wick that popped through but no real trading activity above. If this is the case and then price came back underneath and continued to respect this channel and validate it over and over again like it did, we're going to look at this as just a non-event essentially. We're not overly concerned about it. We'll draw down our main channel where the majority of the time price has found substantial resistance at. Then the next thing we're going to do is we're going to draw the swing lows of this downward trending channel and look to find a straight line that represents that area as we decline. So that'll be just drawing support. So we're going to outline the bottom of these swing lows. Mostly, I prefer to outline where price action has shown candles open and close more so than just a wick push. That means that if there is a wick over here that, for example, extends down here, I don't want to draw my support based on the complete extension of that wick. Instead, I'm more interested in drawing it based on the logical turning point that price is taken. And man, my lines are just really off the wall today. It's that excitement for the 100th video mark. But drawing a area or a channel with support and resistance as the basis is relatively simple. If you get better at drawing support and resistance, you'll get better as a rule just drawing channels themselves, because it is nothing more than a dynamic area of support and resistance. It's just a moving or sloping channel in the case of a bullish or bearish channel. There are two main ways that we can trade a price channel. We can either trade the bounce or trade the break. Those are our two choices. The bounce is going to occur when we're still inside the price channel and we're treating the top line as resistance and the bottom line as support. Ideally, when we're trading the bounce, the way that we want to do that is first identify our top line. We already talked about how we're going to do that, so we're not going to go into that again, but instead we need to understand that we want to find at least 2 points to consider our top line something valid. So we want to find at least 2 locations where price has come up to and validated and confirmed that we do have some type of resistance where we're drawing it. Then we want to go ahead and trade the bottom line of our channel, or draw out the bottom line of our channel. Regardless of whether it's going up or down, we still want to know where this is. Now once we do that, it's going to be done exactly the same way, where we're outlining the lower areas of support, the swing lows along the way down or the swing lows along the way up in the event of a bullish channel. Now the key here is we can trade both support and resistance in a bearish channel, sure. But ideally, we always want to remember that the trend is our friend, which means in the event of a bearish channel, when the channel is sloping downwards, if we only look for selling opportunities when price is trading around the top side of the channel, then we're going to be trading with the trend and have overall momentum on our side, and this is the more favored approach. However, we can still find buying opportunities. It's just a bit riskier during a downward sloping market, and the general ceiling on how far we expect to gain in terms of the movement from that location is also expected to be a bit more limited because we're going against the prevailing trend. Trading the break is the exact opposite of trading the bounce, because with trading the break, we're not looking to trade inside the channel. Instead, we're waiting for the channel to break and we're waiting for price to close and trade below the channel or above the channel. Either of these are acceptable versions of a break, and depending on which direction the price trades and breaks above or below, that will determine which way we're looking to go with the market. Ideally, if the market is trading sideways like we see here in this example, we have a horizontal channel. Now, this is something that can give us both bullish and bearish entries depending on which way it breaks, or even on the bounce scenarios. But with this right-hand side of the screen, we can see that price came and closed down and below and continued to stay below in the next candle. This is a very strong bearish trigger, and we can use this as a justification or further justification to look for a selling opportunity. If price had theoretically gone up to the top side and done the same thing up here and was now trading up above the top trend line, This is a very bullish opportunity, and we can look at this as an opportunity to jump into the market with an expectation that the buying pressure that allowed us to break the trend, we are no longer conforming to this particular trend. The fact that we did break that indicates that there's enough buying pressure that we could reasonably expect a further bullish push in the market. Those are the ideas that we want to consider, and that's why trading the break makes sense just as much as trading the bounce. You'll have to decide that trading the bounce is more your speed, or perhaps trading the break is more your speed. If you prefer the larger movements, the larger and more volatile reactions, those are more often than not going to occur once it breaks. So if you like the longer term trades, you like the bigger swings, usually the break is going to be where you'll find them. If you're trading the bounce, you're more or less looking, depending on the size and the scale of the channel that we're looking at, of course, you're more so looking at something that will allow you those scalping opportunities to take advantage of those common areas of support and resistance that are currently holding the market in some contained manner. Both of them are a very different skill set and require practice before going live, so I strongly recommend that you take the demo account out and you start putting in a few little lines on your chart and see how they would theoretically perform. Draw out the top line, draw out the bottom line, and have some fun with it. Get some practice in before you take it live, and it could be a very powerful tool to add to your arsenal. Until next time, folks, thank you for joining me for our 100th video. I appreciate all of you so very much. I will see you on the next one, and I'll see those of you that pass the Gauntlet Mini on the inside. Cheers, folks. Bzz.